Welcome everyone to the Kentucky Retirement Systems Investment Committee meeting. It's August 20th, 2025, 10 a.m. And I would like to call the meeting to order. Victoria, do you have an opening legal statement?
Yes. For the record, I want to note that this is the meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you're speaking and not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. And Sandy, would you like to do the roll call?
Certainly. Mr. Lane, Mr. Atkins, Miss Bova,
Here?
Miss Thompson.
Here.
We have an unidentified wireless caller. If they could make their presence known or see who they are. Okay.
Did somebody who's on video also have to join by phone? Other than Steve. Looks like Steve did, but
Yeah.
there's a second one.
Oh,
You can just move them to waiting, Sandy.
okay.
Move them to the waiting room and they'll call you and let you know that they need to be in.
Okay.
Was that the end of the roll call? I'm sorry.
Yes. We do not have a quorum, but we can proceed with the meeting. We just can't vote on anything without quorum.
Okay, perfect. Thank you, Sandy. I think Sandy said there are no public comments, so
Correct.
we will move on from that. Um, we're not going to approve the minutes because we don't have a quorum. So, would Wilshire like to do the investment review and update?
Yes, thanks. Hi, everyone. I'll kick it off, and Chris will join me with some materials in just a few minutes as well. But we'll just we could go to page number 12, and I'll talk to this page in just a minute. But to make a few opening comments, certainly the second quarter was a bit of a wild ride. If we think about the whole first half of this year in equity markets, we had a peak on February 19 in the U.S. equity market. We had early April with the tariff issues and Liberation Day, and a huge market sell-off that began in April, only to rebound to new records post that, even early into that second quarter. So I'll leave all that to Chris. He's going to cover some of the market returns across equities, fixed income, real assets. But just some other commentary before we talk about rates a little bit. GDP was a strong quarter of GDP, a 3.0 print of GDP, following a slightly negative print of the first quarter. And some of the things that we are seeing and focused on and talking about in all of our investment meetings are there are signs of softening from both the labor market and consumers. Consumers drive, as many of you know, about three-quarters of our GDP. So much of it is truly in the hands of what the consumer is doing. And consumers have been slowing a bit. But interestingly, when you break apart GDP, it's goods and services. And from a services standpoint, consumers are still spending. So people, they want their experiences. They're spending money on these things, going out to dinner, going to events, etc. Where the softening is happening is on the purchase of goods. So we're seeing a little bit, all of that, a little bit of slowing. So that's kind of one thing as we step into this next quarter and think about where things go. Secondly, if we take valuations, Everyone has talked for quite some time about valuations being so high, particularly in the U.S. equity market. No question, high valuations. We have concern about this. There's also debate about this on both sides that some will argue that there's enough productivity happening driving corporate earnings, and actually there has been, but that would continue. If we continue to have strong corporate earnings, we may continue to hold up with these strong valuations. That's sort of one side of the argument. AI plays a significant role in that, technology improvements. On the other hand, on the other side of that, there's a lot of uncertainty and risk in different economic assumptions. We look at things like this slowing, and what does that mean for just growth in general? What else does that mean for the labor market? What's it mean for inflation, et cetera? So there's sort of two sides to that whole discussion, but sort of the takeaway is valuations are very high in the U.S. equity market. So that's that. If we go to 12 and we talk about rates for a bit, this is interesting. Everyone's sort of waiting to see when are we going to have cuts? When are we going to have cuts? The two horizontal bars here are surrounding the second quarter, and if you look at that, the top section is just the 10-year Treasury. Throughout the quarter, started the quarter at about 4.2%, ended the quarter around 4.6. So you see the fluctuation around that. And then if you drop all the way to the bottom, that's the 10-year break-even rate. So this is the break-even on a 10-year Treasury versus a 10-year inflation indexed bond. And this is essentially the market's expectation for inflation on a forward-looking 10-year basis. And that is about 2.3%. So the line in the middle, the real rates meaning adjusted for inflation, we have about a 2% positive real rate. So if you invest in simply a 10-year Treasury risk-free today, you can expect about 2% over inflation based on how the market is pricing things today. So that's a little bit on rates. If we go to the next slide, 13, more on rates, looking at expectations for Fed funds rate cuts. This is certainly a topic daily. The Fed the group is in Jackson Hole today and tomorrow and the end of this week doing one of their annual gatherings on discussing a lot of these things. And if we look at what is the market, what are market rates implying? That red line in the middle shows that's a projection out to December. So end of this calendar year, market rates are implying two more cuts by the end of the year. So we'll see where that goes. This is a continued debate between people who think rates need to be down now and be down significantly versus the Fed, who has been trying to very carefully balance what they're seeing in terms of growth and in terms of inflation and the different signs that we all look at, on a regular basis. So that's the implication right now. Two cuts by the end of the year. We'll see. And then just a little bit more, kind of the other big topic is the US dollar. But if we go over one more slide to 14, this touches on tariffs. So tariffs are obviously tons of uncertainty here. We don't know where this will land. I think really no one knows where this will land. But this gives you a picture back over roughly 5 years, that rolling red line. It's about a 2% net tariff rate that has been history over the past 5 years. That is approaching, it's up around a 9% rate right now, 9% tariffs. So a lot of this remains uncertain. We'll see where it ends. But that is potentially driving inflation, economic concerns, et cetera. There's a lot to fall out yet that we don't know about, but this just gives you a picture of what does all this look like in aggregate at this point. And then that certainly has, the uncertainty about tariffs, about rates, and about even the US's long-term debt position drives what has been happening with, on the next slide, we show the US dollar. The first half of this year, we've had a roughly 10% sell-off in the US dollar. So things that are driving that are all of these concerns, the um, geopolitical tension globally. Particularly, I'll go one more slide, this next slide that shows the US's current debt levels at 36 trillion, 120% of GDP. You hear about this all the time. This is big in the news, a big topic, and all of this is starting to feed this, and tariffs and everything starting to feed a little bit globally on the US dollar. So to some degree, we've had, to some degree, there's some reversion to the mean in this, and that the US dollar has been strong for quite some time. But, so much of this is about uncertainty, which means it can change quickly. So we don't have a forecast on where this lands, but just trying to put all this in front of you. This is the kind of activity we've had throughout the year, and particularly in this second quarter. On top of all this, we've had very strong capital market returns, which Chris will take us to. So, that's kind of the backdrop for everything. And maybe, Chris, you'd like to pick up with some of these charts to show some of the capital market returns that we've seen.
Sure. Thanks, David. If we go to slide 26, we'll first touch on the US equity market, and we'll focus on those first two columns. If we focus on the first column, just the second quarter, you can see the US equity market as measured by the FT Wilshire 5000 was up just over 11%. And that was still driven by the large caps. Nearly 12% of the return came from the large caps, but small caps still have strong performance at 7%. And if we move down into the growth and value sections, you will see that the growth, large growth specifically, really drove the market. So those Mag 7 that we heard so much about over the past year as being such a concentrated market really did bounce back after Liberation Day. Almost 20% return from the large growth sector, while we only got about 4.3% from the large value. On the small growth side, again, growth leading the way at 9.3% versus 4.7%. But if we move over to the right-hand side, the year-to-date number on equity markets still very strong halfway through the year at almost 6%. You can see that the large cap is still driving that return year-to-date at 6.6%, while small cap is roughly even for the year. And as we move down to the growth and value again, I just want to call out that the large growth versus value on a year-to-date, we're seeing much more parity between large growth and value. So there has been a little bit more of a bounce back, especially in the first quarter from the value that we saw. So we're seeing a much more balanced return year to date between large growth and value. And even on the small growth and small value, those are relatively tight, with small growth being down about 30 basis points and small growth being down 30 basis points and small value being up 10 basis points. If we go down to the lower left-hand section here and see just the sector weights and returns, you can see that information technology is making up about 30% of the index right there. And on a year-to-date basis, we've gotten about 7.5%, but really that IT had the largest outperformance or performance, if you will, at 23.5%. Communication services was second at about 18.6%. And there were really only a couple of detractors during the quarter, which were the healthcare and energy sectors. For the, again, FT will market, but in those blue diamonds, we're showing what the largest kind of sell-off was. Historically, several over 20%, but if you kind of look down where those diamonds are, during those even banner year returns, we had many that had double-digit sell-off periods. So this is a really good reminder that we are long-term investors. We can't overreact or panic to sell-offs. And we need to make sure that we are rebalancing so that even when there is a sell-off, we can participate in that upside that we've seen here in so many years, where we've had double-digit losses. We end up with double-digit returns. If we can move to slide. Those first two columns, for the quarter, non-US, as represented by the ACWI ex-US gross of dollar, is 12.3%, so slightly outpacing US equity markets. And it was relatively equal between EFA and emerging markets. The ACWI ex-US growth had 13.8% versus the value at 11.4%. And small cap was really the kind of star here at 17.2%. But the really, kind of two themes here is A, non-US equity markets outperforming US equity markets, seeing a lot going on overseas, but also kind of the breadth and depth here. We're seeing it across all markets, EFA, emerging markets, growth and value. Everything has performed very well overseas. And on a year-to-date basis, on the ACWI ex-US, we're seeing over 18%. And again, really EFA and emerging markets doing both very well, 20% and 15.5% respectively. So seeing really good non-US equity market performance. David talked about US equity valuations being stretched a bit. We've been talking about that for several quarters. Non-US equity markets, we said, perhaps offered better valuations. We're really starting to see the non-US equity markets shine right now. If we can move on to slide 32, next slide. Fixed income markets. David talked about rates quite a bit. If we look at the lower right-hand quarter, just that treasury yield curve, I want to focus predominantly on the light blue and the dark blue line, with the light blue line being the yield curve as of the end of 3/31, and the dark blue line being the yield curve most recently as of 6/30/2025. And you can see there was a slight steepening in the yield curve where short-term rates came down a bit and long-term rates came up. Ultimately, what that means is that we had relatively positive performance for the quarter. The aggregate was just up over 1%, leading to a year-to-date number of 4%, which is really nice for your core fixed income, which again is your kind of your safety and liquidity source within the portfolio. Corporate bonds were giving 1.8% for the quarter and 4.2% over year to date. So you can kind of see versus the treasury of 0.8 and 3.8 of that year to date number, there's only about 40 basis points of excess return, if you will, the corporate over the treasury. So yields again, kind of very tight in the corporate market, and for the extra risk that you're taking there, treasury markets still look very, very solid compared to the corporate markets right now. And I just want to call out tips as well. While tips only had about 50 basis points during the quarter, year to date, they are at 4.7%, and high yield over that same time period is at 4.6%. So tips have offered a really nice bump in the return as well. And if we can move to slide 37. We kind of refer to this as the heat map, and I think this is a really nice way just to be able to see how different asset classes have performed on an annual basis through the years. If we go to the far right column in the box on the left, you'll see the 2025 year-to-date number, and you'll notice that the top three boxes in there are all equity components. So this is still very much an equity-driven market that we are investing in. Developed markets nearly at 20%, emerging markets at 15.5%, which we talked about just a minute ago, and US equity markets at almost 6%. So strong equity returns, but as we went through the volatility that we saw coming out of Liberation Day, and just some inter-quarter commentary here, as we did see those sell-offs happening, many other pieces of the portfolio did exactly what we hoped they would. Our bonds and tips, some of our diversifying asset classes, they really offered a nice ballast to the portfolio, and we didn't see large drawdowns. And you can see that kind of through here, that commodities at 5.5%, tips at almost 5%, core bonds at 4%. year to date. Those are performing very, very well. And so we do have a lot of different levers that, can be pulled on during market drawdowns. And that's kind of represented by that box here on the right. With that, I'll pause and see if there are any questions on second quarter performance for David or I. And if not, I will hand it over to Steve so that he can cover the K-Plan's portfolio performance.
Thank you. Sandy, could you turn to page 40, please? Thank you. Good morning. We have a full agenda, hopefully an investment recommendation, assuming we have a quorum. So I'll go through this pretty quickly. Wilshire did a really good job of covering the economic and market backdrop for the quarter fiscal year. I think I didn't do a word count, but I heard uncertainty several times. As we know, uncertainty leads to volatility, and that's exactly what we saw during the quarter. As Wilshire mentioned, after falling into correction territory in April, U.S. public equities regained their momentum to close the quarter at all-time highs, with non-U.S. public equities, credit spreads, and treasuries also able to join the rally. As officials indicated, progress towards multiple trade deals, armed conflict in the Middle East subsided, Congress continued working towards passing a reconciliation bill, and the Fed signaled a need for continued patience. As David mentioned, I think that's being battled in the market on a daily basis. We've seen both some headlines regarding Fed members as well as expectations for when we'll start cutting rates, if we'll start cutting rates. Markets are pricing that on a daily basis. And as David mentioned, that we look at right now about 2 cuts through December. So further easing, which should bolster the economy. Consistent with this overall positive market backdrop, the portfolios rebounded to produce positive performance during the quarter to close out the fiscal year with very good full year performance. I must say, these meetings are a lot more enjoyable for me personally when we're presenting positive results. So I enjoy these meetings. The KRS pension composite produced a return of 5.47% for the quarter, outperforming the blended benchmark by 99 basis points. The KRS pension portfolio returned 5.30, and the SPRS pension portfolio returned 5.34 versus their benchmark's return of 4.31%. The KRS hazardous pension portfolio returned 6.29%, and returns for the insurance portfolios range from 603 to 630, all compared to their benchmark's return of 531. During the quarter, the largest contributors to outperformance were the outperformance in the real return public equity and private equity portfolios. The non-U.S. public equity portfolio performed especially well, with 7 of the 8 managers outperforming their respective benchmarks, and the overall portfolio outperforming its index by 133 basis points for the quarter. The portfolios also benefited from an overweight to non-U.S. public equity. As David and Wilshire mentioned, that was a strong performer for the quarter, outperforming U.S. public equities and their U.S. counterparts by over 2% during the quarter. The only area of noted underperformance was the relative performance of the specialty credit portfolio, which underperformed its benchmark by 73 basis points, which was largely driven by its larger exposure to floating rate issues. For the fiscal year, the KRS pension composite produced a return of 11.30, outpacing the blended benchmark's return of 9.82, and the KRS insurance composite produced a return of 11.55, outperforming the benchmark by 76 basis points. On the individual portfolio level, performance ranged from 10.96 to 11.87 for the pension portfolios, and 11.18 to 11.75 for the insurance portfolios. Putting that outperformance in context versus the benchmark for the fiscal year equated to 102.8 million of outperformance for the pension portfolios and 21.6 million of outperformance for the insurance portfolios. So a very strong fiscal year. During the year, the specialty credit, real return, and real estate portfolios all outperformed their benchmarks and were the main drivers of relative outperformance. The real return portfolio outperformed by 1,044 basis points. The real estate and specialty credit portfolios outperformed by 346 and 108 basis points, respectively. For the full year, the overweight to non-US public equity relative to US public equity was a benefit to portfolios, with these markets outperforming their US counterparts by over 2.5% for the full year. The main detractor to performance during the fiscal year that we'll talk about a little bit later was the 305 basis points of underperformance in the private equity portfolio at the total pension level, and that's relative to its public equity benchmark plus 300 basis points. Page 49, please, Sandy. There are a few asset class performance highlights from the report that I wanted to note. For the fiscal year, specifically, the global equity portfolio returned 16.14% versus the benchmark's return of 15.89%. Again, with that non-US tilt of the portfolio benefiting overall performance. Drilling down, the US equity portfolio produced a return of 15.09 versus the Russell 3000's return of 15.3. So modest underperformance in the US portfolio, while the non-US equity portfolio returned 17.95% versus its benchmark return of 17.83. So modest outperformance on the non-US side. The core fixed income portfolio produced a return of 6.27% for the fiscal year, outperforming the benchmark by 19 basis points. As mentioned, the specialty credit portfolio outperformed by 108 basis points with a return of 9.87%. Over the last 5 years, this portfolio has generated a return of 8.98%, outperforming the benchmark by 223 basis points. So very strong performance in that specialty credit portfolio. The real estate portfolio for the year produced a return of 4.6 versus the benchmark's return of 1.2. So a strong performance in that real estate portfolio as well. Within that portfolio, the 3 open-end core strategies, which represent the bulk of the exposure, about 2/3 of the total investments, all produced positive returns during the last quarter and have now posted positive trailing one-year returns for the first time since 2022. So it's nice to see, as David mentioned, that diversification aspect with real estate performing well on a trailing one-year basis. The real return portfolio was really the standout, and it performed exceptionally well with a return of 15.8% for the fiscal year compared to the benchmark's return of 5.4%. As we've highlighted in the past, the portfolio's MLP exposure has really been what's driving that real return portfolio's performance. For the year, it produced a return of 26% and has returned more than 30% annualized over the past 3 and 5 years. Page 42, please, Sandy. Thank you. The internal portfolios all performed in line with expectations and objectives during the quarter and for the fiscal year. As a reminder, the majority of these assets are passively managed and intended to replicate the return and risk of public indices, which really provides inexpensive beta exposure to what we view as the more efficient markets. It also provides staff flexibility in rebalancing the overall portfolio's asset and risk allocations. Additionally, staff manages a number of proxy portfolios to gain exposures to assets with similar risk, return, and economic characteristics that serve as a transitional position for less liquid asset classes as committed capital is called by managers and staff sources new investment opportunities. I would note on this report, the scientific beta portfolio was retired in June and transitioned to the 2 recently approved new large cap US public equity managers. The balance reflected on this report was the result of that transition and was transferred to the new accounts in July. So that was just kind of the tail of the transition. It's a small amount here. That, as we know, we talked about when we made the recommendation to close that portfolio, that factor-based portfolio, it had really underperformed given the market conditions. Happy to report that the 2 new managers through the first 6 weeks of management are performing well, doing in line with expectations. So I think that was a good result for the overall portfolio. Page 43, please. For the asset class performance, while that prior report showed that the asset class performance at the total trust level, again, these reports are intended to show asset class performance at the individual portfolio level. As I've noted before, these reports from BNY currently are only able to show gross performance. We are working on a project with them to provide this information on a net of fee basis and hope to be able to roll that out soon. I think the important thing to note in these reports is the tight dispersion of asset class performance between portfolios. That's what we want. We try to maintain consistency across portfolios. There's really only modest differences that are based on specific allocation of each portfolio to the underlying mandates that make up each asset class. The notable outlier here is the private equity asset class, where the large dispersion, especially between pension and insurance portfolios, is largely driven by the different vintage profiles among the portfolios, which is something we will also talk about here in a little bit. Page 68, please. From an attribution perspective, the one thing I really wanted to highlight is that chart in orange on the bottom right. For the fiscal year, despite that market volatility that Wilshire discussed and all of that uncertainty, the portfolios and managers were really able to produce consistent positive alpha contributions across asset classes. I think that's important. That goes to that diversification element that Wilshire talked about. Again, the notable exception is that private equity, which for most portfolios failed to keep pace with their public equity benchmark. And this benchmark mismatch is an issue that we've previously discussed. I think we believe there are better alternatives to allow the committee and board to better evaluate the actual performance of the asset class. We just had a call this week. We're working with Wilshire and hope to make a recommendation to update the benchmarks, hopefully at the next investment committee meeting. So look forward to that. But really, the takeaway here is the positive performance across asset classes. The green are the allocation, the orange is where I really think the focus, especially for the full fiscal year, should be in the positive contribution across all asset classes. Page 74, please. As always, some of my favorite Wilshire charts. All of the pension and insurance portfolios have produced exceptional top decile risk-adjusted performance over the reported 1, 3, and 5-year time periods. And this is based on Wilshire's all public plans universe, so the broadest universe that they have. As the graphs show, the portfolios all have sharp ratios in the top 5% of this Wilshire universe over all of the reported time periods. We really believe this is an important metric, as the asset allocation guidelines provided by the investment committee and the board really determine the specific risk parameters and constraints under which staff constructs and manages the portfolios. And these risk-adjusted return measures demonstrate the efficiency of the performance produced by the portfolio. So that's something we're very proud of. I think that speaks both to the oversight of the investment committee that got the marching orders that you provided, as well as our ability to deploy that capital into, as we noted on the attribution reports, to managers that are outperforming. Page 80, please. Thank you. Over the last year, large public plans, as I'm sure you're aware, broadly underperform their smaller public plans. And that, again, as we saw in the prior year, mostly due to larger allocations to alternative investments and asset classes. As we saw, public equities tended to be the dominant driver. For most markets, smaller plans tend to have a larger allocation to public equities. The diversifying impact of those alternative asset classes sometimes cuts both ways. It benefits performance, especially in volatile markets. But when we're in very trending public equity markets, that tends to hinder performance relative to those with larger allocations. I would note that Wilshire's broad all public universe, the one that's demonstrated here, had a median return of 11.06 for the fiscal year. And the portfolios produced second quartile performance within this universe. The median return for Wilshire's large plan universe, which Wilshire can certainly talk about, but I believe that's AUM above $1 billion, was lower than that broad at 10.10% for the fiscal year. Something else we look at is the BNY's all public plans universe, which is part of their custodial relationships. That had a median return for the fiscal year of 10.65. So again, just demonstrating the strong performance on an absolute and a relative basis of all of the portfolios. Page 86, please. As of the end of the fiscal year, all asset classes for each portfolio were within the IPS specified range, with a majority of the positioning within 1% of the respective target allocation. We've moved those over time. As you know, if we looked at this graph 18 months ago, 2 years ago, We were outside of the ranges for a number of asset classes, so staff has done a lot of work to move all of the asset classes to within the ranges that are provided by the IPS. During the quarter, we took opportunities to reduce the overall overweight to global public equities and rebalance between U.S. and non-U.S. equities. As you can see, we've maintained an overweight of approximately 3% in public equities, and that's partially an offset to the underweight in the other growth asset class, which is private equity. In core fixed income, we've maintained that neutral overall duration and yield curve positioning. As Wilshire mentioned, we've traded in a pretty range-bound manner. We've seen a slight steepening of the yield curve, partially on expectations about economic growth, as well as the expectation for Fed action going forward. I think it's likely we're going to maintain that positioning until there's further clarity on policy, tariffs, and economic fronts. Lots of uncertainty, as Wilshire discussed. As managers have called capital in the real return portfolio, we have unwound the liquid proxy positions to fund these investments. We continue to work on additional investment opportunities in the asset class and hope to have all of the proxies fully unwound by the end of this fiscal year. So that'll be a major accomplishment. The largest underweight remained in private equity. Historically, we viewed the asset class as having limited value from a relative risk-reward basis, with better opportunities available in other asset classes, which has been borne out to some extent by the broader private equity performance we've seen in the broader private equity market. As we mentioned at the last investment committee meeting, we've begun to focus more on the asset class, partially as that recent underperformance and funding difficulties they've experienced have created a more attractive landscape. And today, Anthony will be presenting a new private equity investment opportunity. So we're excited for that. That was all I had on the investment performance and allocation. Happy to answer any questions, or we can jump into the investment budget. No questions, Sandy. We can go to page 124, please. Overall investment expenses for the full fiscal year were in line with the budget, with a total of $11.3 million spent during the year, which was 89% budgeted. This did represent an increase of $4.0 million or 55% from the prior fiscal year. A significant increase in legal expenses, which were up $3.8 million or 173% from fiscal 2024. I would note that Michael and his team did a great job in anticipating and budgeting for these increases. We all know that it can be notoriously difficult to anticipate. And for the year, 88% of the amount budgeted for legal and auditing services was spent. I would also note that while still elevated from a historical perspective, we are budgeting a decrease of $1.2 million for legal expenses in the fiscal 2026 budget. And that's based largely on the anticipated decrease in overall litigation activity. Consulting services for the year totaled $1.6 million, or 82% of the amount budgeted, and all line items were in line with expectations, with the exception of that new private markets consultant. That's a project that we had slated for fiscal year 2025, but it's been delayed. We hope to be able to undertake that this fiscal year. Overall contractual services were also in line with budget, with a total of $3.6 million, or 101% of the amount budgeted spent during the year. Obviously, custody fees make up the bulk of this category at $2.9 million, or 80% of the expenses incurred. And I would note that the custody fees were modestly higher than budgeted, which was partially driven by the increase in number of accounts and transaction volumes. Also would note that we have continued to see an increased push for monetization from data providers, including index vendors. So we do expect to see these costs continue to rise. Page 127, please. Thank you. At the total pension level, investment fees and expenses increased by $20.3 million, or 14% compared to the prior fiscal year. This increase was primarily driven by performance-based fees across alternative asset classes, as those asset classes experienced positive performance. Overall, real estate fees and expenses increased by $7.8 million, including $5.5 million increase in the performance fees. That was really as a negative accrual from the prior fiscal year was reversed. Real return fees and expenses increased 7.1 million, including a 4.7 million increase in performance fees, as we saw strong performance in the real return asset class that we noted. Private equity fees and expenses increased 2.5 million, which included a 4.8 million increase in performance fees. Also notable on the overall budget is that the administrative expenses increased by 2.7 million. Again, that was largely due to the increase in legal expenses that we talked about on the prior page. Fees and expenses for public equity increased 2.4 million, which was driven by the appreciation of the market value of the portfolio. And specialty credit was the notable exception, with overall fees and expenses declining by 2.6 million, which was led by the 4.9 million decrease in performance-based fees. That's all I had on the investment budget. Happy to answer any questions. So Sandy, I know the next section is the investment recommendation, but if we don't have a quorum, I don't think we'll cover that in this meeting. I'll leave that to Ms. Bova.
That sounds good. We're still without the quorum.
Yes, we still are
Okay.
without the quorum.
Okay, well, Carrie, should we move on to your investment compliance review?
Yes, that sounds like a good idea. I believe that's on 142. Thank you so much, Sandy. I'm Carrie Bass, the compliance officer, checking in with the quarterly investment compliance report. We'll go to the next page, Sandy. All in all 19 guidelines in the KRS investment policies were in compliance during the quarter ending June 30th, 2025. Take the next slide to take a look at each of those guidelines. And then we'll take the next slide, Sandy. As you can see, there are no exceptions noted. And on the following slide, page 146, you'll note that there were no out of compliance exception reports for the quarter ending June 30th, 2025 regarding asset allocations. You've already seen that in the previous materials, but I wanted to note it here as well. And then finally, for the quarterly compliance report ending June 30th, 2025, the proxy report for that quarter is now listed online in full compliance with the statutory requirements. And on the last slide, I wanted to briefly provide the committee with an update on investment compliance and how the progress with that program and how it's going. Right now, I'm working on ensuring that we have all unredacted external investment manager contracts compiled in a centralized location and make sure those documents are organized and streamlined, ensuring that all required redacted external investment manager contracts are available on the KPP website as required by statute. Working with BNY to continue to improve guideline compliance reporting, and we've got an updated securities trading policy under review by the KPPA staff. If anyone has any questions for me, I'm happy to take those questions at this time. Thank you so much.
Thank you, Carrie. So I guess, do we need to discuss about getting back together for when we do have a quorum, or will someone will reach out and let us know on the items we didn't vote on?
The minutes can be definitely moved to the next investment committee meeting.
Perfect.
I don't know, Steve. I'm assuming that there's going to need to be a special meeting for approval because of the date on the private equity investment.
Yeah, I think I'll let Anthony weigh in, but I think we'll probably need to call a special called IC in order to present and vote on that private equity recommendation.
Yeah, ideally,
we can have Sandy and Sherry coordinate.
Okay.
yeah, since it has to have ratification, I think ideally, before the regular board meetings, the fundraise will go on for a little bit longer, given how elongated they are these days. But still SVP is pretty popular, and making sure that we get the amounts we want closing earlier would be better. So that's what we'd recommend.
Okay, thanks, Anthony. Sorry we
Sure.
couldn't do your part today.
That's okay. Yeah, we'll figure it out. Thanks,
Okay.
Ramsey.
So Anthony, were you suggesting, sorry, you just said before that, so September 11th is the KRS board meeting at 10 a.m.
Gotcha.
So was that the date you were potentially aiming for a special meeting? I know Sandy and Sherry will still have to coordinate to make sure that's.
Yeah, sometimes
I-
before, sometime before that, I think. Or sorry, Steve, go ahead.
Yeah, I think that makes sense. As Anthony was saying, I think because it's going to require board ratification, so we don't have to call a special board meeting as well. It would be nice to have it voted on, assuming it passes before that meeting, so it can be an agenda item for ratification of that meeting.
Okay, so you weren't saying that day, it was just before that date.
Yes.
Okay,
Yeah,
thank you.
and I can work with Sandy and Sherry to coordinate with the IC members.
Perhaps since we already have that board meeting on the calendar, I don't know how much time you need, but could we have like 30 minutes before that meeting? Or do you need more than that?
Sure, I think we could do that,
Yeah.
assuming availability of a quorum.
That's a good
That's a
idea.
good idea. Thank you.
Yeah.
Okay, well, I guess we will hear back on that.
Okay.
Perfect. And is there anyone else have any questions or comments, or we can adjourn if we're ready?
Sounds good to me.
Okay, great. Y'all have a nice day.
Thank you.
Thank you very much.
Thank
You as
you.
well. Thanks.
Thanks.